There are many things that we can do in life where we have the option of representing ourselves and making our own decision versus engaging the skill of someone who does it for a living. And property investment is just one of those many examples. A lot of the DIY property investors will form out a purchase price or a budget in their own mind, get a pre-approval, and then start driving around looking for properties in their own backyard, and then wonder why they didn't achieve as much as what others might have. Before we get into the exciting bit with our property investment clients of talking about specific locations all around Australia that we should be investing in, we first want to actually ascertain exactly what is it that we're trying to achieve, hence the power of financial planning. Before we start talking about locations, our objective is to design one of these for our clients. A property investment plan containing about 80 pages, chock full of content specific to our individual client. The process that we go through is, what is our starting position? Where are we now? What year are we in? What equity have we got? What capital have we got? Then there's a formal process that we go through with our clients to work out where would we like to be. Are we talking 10 years time, 15 years, 20 years time, however long it's going to be. When we get to that point in time, if our goal then is to exit the workforce, but we still need an income, where's that income going to come from? Well, how much income does that need to be? If we're not going to go to work to earn a living and we're relying on our investment portfolio to provide that income, let's establish how big that income needs to be. So let's describe that lifestyle. Once we've done that, we can then work out the value that our assets need to be at that future point in time. What tools are available to us? So we've got a starting position, an end objective. What are the things that are available to us as financial people? Things like our investment cash flow, how much capital is available, whether that's in the form of equity in existing properties or whether that's cash or shares or whatever that may be. Negative gearing, positive gearing, different types of debt structures. I'm not talking here about Commonwealth Bank versus National Bank or 6.9% versus 6.2%. I'm talking about different types of products. What's the most suitable product to make our money working harder as opposed to us working harder? And superannuation. Is it appropriate to continue with our existing superannuation fund that perhaps our employer is paying our money into and we're having no involvement with that? Or is it more appropriate to perhaps do something with a self-managed superannuation fund? Or is it quite okay the way it is? These are some of the many things that we consider with a property investment plan. How might life change? We have established where we are today, but a plan is exactly that. It's not a guarantee, but the more accurate the plan is will be determined by, I guess, the quality of the questions that we ask ourselves. Things such as, how might our job change from where it is now to say 2 or 3 years ahead? How might our income attached to that job change? How might the family structure change? Is someone about to, is there a pregnancy on the horizon and income might reduce? Is there a job promotion on the rise? How might the family home itself change? Are we considering buying a family home for the first time? Are we looking to upgrade or downsize? And how will these things affect our investment capital and our investment cash flow? We factor these things into our plan. And then most importantly, we don't get to a point down the track where something goes wrong and we're backed into a corner and our only option is to dispose of a perfectly good asset. We think in advance what could go wrong. And we design these things, we tailor these things into our investment strategy. What if something happened to our health? What if something happened to a job? What if interest rates went through the roof over a short period of time? What if the market outlook itself in different locations changed with little warning? All these things would form part of a well-tailored risk management strategy.